How do you know you're ready to buy a commercial property? Hi, I'm Sam Powell.
And I'm Jared Krause, and we're the hosts of the Property Powers Australia podcast. And in this episode, we're going to be discussing why and how buying residential property is quite different to buying commercial property and the nuances between those.
Yeah, we also discussed the lessons learned during this commercial property finding and negotiating phase of Jared's journey that he's in, which is really quite interesting because we don't see many of those sort of conversations going in this point of the time in people's buying journey with commercial property.
Yeah, I also bring up a point around the passive income of residential property versus commercial property and why commercial property does not actually provide more passive income than residential property and why it's a fallacy that people believe.
Yeah, there's always that expectation versus reality during the commercial property buying process that we delve deep into, which is definitely really interesting. So I enjoyed this conversation, and there's a little bit more there as well at the end, isn't there, Jared?
Yeah, we discuss the mindset of, I guess, not just a successful investor, but a successful person. I talk about the operating system and how you operate as a person and some certain things and sacrifice you need to go through to actually achieve results in property and life. Now, before we get stuck into the podcast episode, obviously, this is not the only way that we can help you for free. We do have our How to Maximize Your Borrowing Capacity mini course. Head to propertypowers.au/resources to get that tool to help you buy a superior asset and achieve a better ROI. Let's dive into the pod. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Samuel, it's been a long time. Just you and me on the pod. Just a solo with just us. It's been ages.
No, it feels like I need to talk more now. The pressure's on, mate.
We're not leaving all the work up to our guests here, are we? We are the guests.
No, but I thought it'd be good to actually have this one-on-one because it's sharing your journey through your commercial property, which not many people actually get to experience it before they actually start the process. So, and I haven't really come across too many podcasts that actually, share this journey, like the buyer's journey, in the middle of the process, which you're right in the thick of. Most people have the all fluffy stories of how great it was at the end, but there's definitely, as you're coming to realise, there's highs and lows in the process, isn't it?
There is. There's missed out on one really good one just a couple of weeks ago. So I guess maybe we start from the start, and I'd love for you to ask me some questions as well around what did I think about this, and also I've learnt so much that I didn't think. There was one really critical thing that you shared with me that I'll get to. But when did I start this journey? I think I got back from Japan, and then I signed with the buyer's agent very start of March. So time of recording now.
6 weeks.
Yeah, end of April. And so we've got all of March. Yeah, it's been 6-7-ish weeks. And from the get-go, as soon as I signed up, I got a property presented to me that day. And
that's rare.
That's pretty rare, yeah. And they have presented a fair few good ones, and we've gone for have we gone for all of them?
Yeah, I think there's been one in WA, 2 in Queensland, and now you got one in New South Wales. That sounds about right to me. What about you?
Yeah. So there was a WA warehouse. There was also WA retail, and then there was one in Queensland. Was there 2 in Queensland?
Yeah, because they were both in that
Both in the
Brisbane.
same street. Yeah.
Yeah, pretty much same street, but they
Yeah. 4.
were different as well from that sense. But yeah, it was I don't know, all really good assets, and it just also shows that there's heat in that market for good quality assets. Like it's obviously it's a no doubt stressful time. It's a lot of money on that sense, and it is difficult for people to act with speed when you're spending a couple $100,000 to a couple million in the commercial space. So it's there's sometimes a bit of a baptism of fire in that sense, is that you have a go, and it's a sign of a good buyer's agent, in my opinion, is ones that you don't secure every single property that you buy, because that's not if you're buying everything that you put in front of your clients, there's a high chance, extremely high chance that you're overpaying on
Correct.
a few of those.
Yeah. So we've been presented 4 deals in a 6 to 7 week process. The one just gone was the warehouse in Queensland. It took a bit of time. I thought I was going to be in the top bidders, and I was. I did get outbid actually in the end, and it was a shame because I really wanted this deal, and I just had to be patient throughout this Easter process. There was 2 times they needed us to submit letter of intent or expression of interest, sign offer, and they did a first round and a second round, which is a final round, and then it was all of the Easter. It was the Easter week period, and I was just waiting, hoping I got it, and then I didn't hear back. And then I just reached out. I was like impatient. I was like, "Where are we at with this?" And they're like, "Oh, we missed it. Let's go back to the drawing board." And then a week later, I got presented another property. So it was good to not just like for the mindset to just be focused on like, "Damn, I missed out on a really, really good deal." And each of the deals that have come through have been pretty damn good, actually. There was one retail deal that I was a bit like, "Oh, I don't know about this," because I had in my head, let's go for only warehouses. But the retail deal was looking pretty good as well. My biggest, I guess the most stressful part so far has been wanting to submit an offer and not having the trust set up and ready. So if people are thinking about buying a commercial property and they're going to do it in an entity, to have that entity set up as soon as possible or before you start the process. I had under the perception that, all right, cool, we can just get the trust set up in like a day, which is what every accountant will tell you. And even good accountants can take a bit of time to get work done. And this one took a little bit longer than I expected. So I was waiting for it to be ready, because I needed to give the trust name and the numbers and everything to the agents to be able to submit offers. So I would say definitely it's a business expense. It's a cost doing business. A couple of grand, get it set up. So that's been the most stressful part so far. Once that's set up, it's like you're basically saying yes or no to deals. And I've been very grateful towards you, Sam. So thank you so much for looking over each of the deals and sort of pointing out some risks. And I've learned so much through that. So I've learned more through you looking at them than me just looking at them. It's great to see your lens.
Yeah. Well, I guess that's thank you, but yeah, you don't know what you don't know. You don't know what questions to ask. But often, I guess people don't have that luxury as well. But you're also paying the buyer's agent as well. It's just that we have the luxury of doing this together and doing the podcast, and that's the whole plan, to share the journey to help educate others. But yeah, there's always something, and there's Steve Polisi a few weeks back mentioned that there's in commercial deals that there's always something that's not going to line up, and running around looking for the perfect deal doesn't exist in that front. And if it does look perfect, then you're not looking hard enough on that sense. And having the confidence to say pull that trigger, and I think that's something that you've learned a lot through this journey. It's just that it hasn't worked out because of budget, which is completely fine. but at the same time, each deal, like there are even some things to say, like if you're wanting to do this alone and not use a service of a buyer's agent, which obviously, to each their own. There's a lot of risks in this front, but you can learn the process, and there's great books out there that can coach you through it. But a little tip is, negotiate on properties, that are above your budget, so to speak. But you're learning everything that you're doing. There's always a lesson through that process. So, if you're going it alone, it's like, well, I don't want to say it too much. Like you're wasting their agent's time by doing that. But at the same time, you're educating yourself onto what steps actually occur. And you sort of alluded to that too, where commercial is different to residential because you're looking at the property, you're looking at the initial deal itself. You don't know what you're actually really buying until you do that full due diligence process, which that's how the deals are structured, and that's the appropriate way of doing it, because you're getting that contract price on the way in, and then you're doing all your due diligence checks, which takes days to do. But you want to get that solidarity of price agreed upon first, and then go back and do it. Whereas Resi is a bit different. There's like a lot of the due diligence can be done on the way in, and then you've got you're building in pest reports and things like that on the way once you got under contract. So what have you found have been the biggest differences between the Resi and the commercial buying process?
Well, Resi's a lot slower and less money, and commercial's a lot faster and more money.
Faster in which way? Like faster?
Faster as in terms of negotiations, getting your offer in. You have more savvy buyers in they're business people, right? They're investors first, and they've invested in multiple assets before, getting to the commercial realm, because it's a higher price point typically, and the investors there are just switched on, and the competition is a little bit more fierce, I believe. Probably less people, but smarter. And then in Resi, I just feel like you can't really. There's not as many elements to stuff up in Resi compared to in commercial. There's so many elements in terms of like the biggest thing is like looking at all the comparables and the variations of the different types of assets, the different types of yields, tenants, the different types of comparables in terms of rents, square meter rates, and the asset type as well. Like a Resi, you can get like a 3. There's so many 3 to 4 bedroom, 2 bathroom homes in that certain area with a bunch of sales. Like it's a lot easier to get comparables typically, and it can build a lot more confidence. I couldn't even imagine trying to invest in commercial by yourself and do it yourself. If you're investing, you want to do it without emotion. And like if you're trying to do it all yourself, and then the more you learn and the more properties you look at, the more emotional you're going to become to go, I really want this one to happen, or you're going to sort of oversee certain things because you're going to become biased because you spent so much time and effort to get to this point. Saying no will be a hard thing to do at times. So, and I can see where that happens in Resi as well. Like I can see where people, they build, and any investment, they build so much, they put so much effort and energy, expenditure and time into it that they sort of go, I need to just make this work. I need to just get in the market. I've spent this much time doing it, and they go ahead and do it. And that having that barrier of an agent for both sides, Resi and commercial, is, I think, it helps you be a little bit more removed and less emotional. So that's been hugely helpful.
Yeah. The Resi, like it's well, both of them, in my opinion, is you just got to pull the trigger and you have a go. The commercial in my brain is, it's definitely more, there's high levels of risk just in getting it wrong. Residential, you can kind of ride it out. If you buy the asset and there's lower levels of, I guess, tenant risk. Like the biggest thing for me is commercial is the tenant risk, and especially for investors that are getting into that space that don't, not everyone has just spare 200 grand in cash sitting in your offset account. So to hold through vacancy periods. So I'm really diligent on the businesses and the tenant sort of tenant selection, but also what rents they're paying. I mean, a good example we're just looking at, the one in Sydney before we jumped on the pod, was it was a newer build. It had a tenant that the business was dedicated towards, I guess, more higher end artesian foods on that sense. So it's they're looking for like a premise just like that, and they're paying good rent for it. And my question always goes to, well, how many people are out there, how many tenants are out there that are looking for that property type? Because, in 3 years' time, when the lease expires, you want to have that confidence that there's going to be another tenant in there to replace them at that similar market rent. Because I've just seen, I'm just the risk adverse valuer, but I've seen there's always dodginess in business too. Like people inflate rents, they sell them, they get them in for these leases. They might have connections with the developer that's done it. They're happy to sign that 3-month lease because the business can write that expense off on the tax. You don't know what's going on in the back end. Investors, especially mum and dad type investors, people don't care about you. Like after the deal's done, they don't care about your financial position. Whereas that's where your buyer's agent should. And then it's also, you should as well. Like, don't trust what's on a piece of paper and what numbers, go through and ask those questions. And that's what that due diligence period of, your commercial purchasing is so important for.
Yeah. You're right. It's the asset that you got to think about how much market is there out there, or how many businesses are out there that are going to want to lease this type of property for this amount of money. And that makes you want to be a lot more alert to that and a lot more sensitive to how the market is performing with that type of asset for that, in that type of location versus resi. If I buy a 4-bedroom, 2-bathroom house or a 3-bedroom, 1-bathroom house in that area, I know that there's, so many people that are going to just come and rent this for like maybe $10 to $20 cheaper a week than, I may want it to be. And it's, $10 a week is nothing in terms of like a loss, $520 a year down is not too bad compared to maybe 10, 20 grand a year down or whatever it could be with commercial. So yeah, you're in a different bracket. You're in a different bracket of investing, really, and it is exciting to learn to go, okay, cool. Like I want to be. I'm like this little, not even a little fish. I'm just like an egg fish about to hatch in this massive ocean, and it's really good to just absorb all this information and learn like how it works.
Yeah, well, that's you're taking the smart approach. You're going the lower risk on the way in for your first, which is you're not going to get the retirement cash flow that everyone thinks commercial brings. But as I said, everybody too, like I'm kind of Switzerland in this on the fence in this sort of whole scenario. Whereas it's like you want to get the deal through because it's that analysis paralysis, not being in the market, you're not getting that growth. But that's where property investors seem to go wrong in. They push it too hard. It's sort of the winner's curse. You get overconfident. and then probably can turn around and bite you in the ass. And it doesn't bite you in the ass with a couple $100 or a couple of thousand. It's usually tens of thousands of dollars that can get you. And the worst part about that is that people give up on the journey. And I don't know a better investment class that doesn't have like the low levels of risk than what property does, that has, the long-term growth prospects, that it offers. So it's like people that get burnt or do the wrong thing, they stay out of it, and then they have to rely on, either starting a business to generate more income, or, their superannuation, or they just forget all about it and then pick it back up when it's, they're 60 and they've, no bank wants to touch you because you don't have any, solidarity of borrowing capacity. And it's, I guess it's a bit of a passion of mine on yours. That's why we're doing this, right?
Yeah, absolutely. And it's so important to, I think more than ever now, is I have heard it from other people say this, like when you can buy property, when's the best time to buy property? As soon as you can. It's like, it makes so much sense, because to get to the point where you have the opportunity to invest in property is, like, even just starting at residential, it's hard and it's a big deal. And to have enough cash to get there. And then more than, like, I'm a business person, right? Like, I teach people to acquire online businesses and get more cash flow. And I'm an advocate for that. But that is also a bit of an active income, where you manage a business and you grow it, and there's no ceiling to how much cash you can get. With property, there is a bit of a ceiling in terms of like how much rent you can get in resi or commercial, but it's far more passive. And what you're doing is when you can buy your first property, is you can get your money and you're literally putting it to work. It's going to grow in terms of capital growth. The way I look at my portfolio now is like, how much debt can I get to buy property? And the more that I can get, which is in the book, The Debt Millionaire explains it perfectly. If you guys haven't read it, get it. Is I'm putting my money to work for me because of inflation, and as that property portfolio grows, it's going to grow in value without me really. Well, I don't have to do anything, right? Just the environment and inflation is going to allow it to grow. And I think that's why it's so important more than ever, is to like get to that point where you can invest in property. If you can, do it, because you're putting your money to work, and you kind of like, you can't get in the way. With a business, like, I'm a bottleneck as an operator. I can get in the way because I'm like, I'm too busy, I got too much stuff on, or I'm not getting to this thing, and the business can suffer. But with property, you just leave it, and the money's growing for you and it's working for you. So that's what I've really realized now, is like, now I'm starting to acquire more debt. I'm like, okay, cool. I'm putting more money to work for me, and it's going to be I think it's far better for people wanting to achieve, retire early or financial independence or some sort of passive income. The faster you can get your money working for you, the better, because the compounding of that.
Yeah, that's a really good, a bit of a tangent, but what's a good tangent with the property pals, right?
Yeah.
But I was having this discussion with another client, and it's like, everyone's out there touting like passive income. Like, in my experience, is there's no such thing as passive income. You should have a bit of a finger on the pulse into what you're actually putting your money to, because sure, you can have sort of, it's the mindset you get, investing a few $1,000s, it's easy to forget. Investing 10, 20, 30, 40, like, it's easy to forget. When you're investing hundreds of thousands, millions of dollars, like, and you will get there, at some stage in your life, you're going to be making, hundreds of thousands, millions of dollars decisions to do with what to do with your money. That's where it becomes more real. So start taking every investing that you do with that mindset of, this is $1 million. I'm investing $1 million, even if it's $1,000. What could you do with that? Call it $1 million. Yes, it is 1,000, but it's just that mental capacity, because what asset class do you want to play in is kind of my point. And sticking to that route. Like, I spent a lot of time, trading currencies and doing stocks and not getting success and not enjoying it because I thought it was you invest and then you're going to be a millionaire, but it's like you're tracking markets, you're tracking the businesses, it's definitely not passive. So you've got to want to enjoy it. If you don't want to sit in front of a computer and analyze stocks and businesses and countries' economic performance, then that's not for you. If you're going to go down the crypto path, I'm telling you right now, that's a highly volatile market. You can make a hell of a lot of money. Don't get me wrong, but you can also lose a lot, or not only money, but time and stress and all that kind of stuff too. So have your strategy and stick to it. And also have this mindset of like it's 10, 20 years, 30, 40, 50 years. But going down to like the passive income side of things too is like property is not passive either. Commercial is more passive than residential because your tenant generally pays most of the outgoings. It's your own best interest. You're there to just own the asset and collect the rent and maintain that premise. When and you need to. Residential is kind of the same, but you're the one that's paying for the hot water system. You're the one that's, getting the gutters cleaned and looking after it because that small amount of money you're putting into it now, is going to maintain that asset's longevity and have bigger headaches in the future. And that's like the way that you structure your life. And that's what I love about it is that you've got a vehicle that's generating you income. That there's risk in there. We talked about this. Business is risky. That's why you're getting the often large income returns through business. What are you doing to utilize those funds that are coming in to put into a lower risk investment type? And what you're doing through that synergy is, like in my mind, is probably like the smartest strategy that I've seen that's out there. Like you can do other there's more passive income plays in that you just give your money to somebody from a joint venture or a equity funding partner. They then pay you a dividend, but there's risk in that too. You've got to analyze the people you're giving your money to. It's very easy for a company to shut up shop, call bankrupt, and then you just lose hundreds of thousands, millions of dollars. Whereas if you own the title to a piece of property, that's just more secure in my eyes. And then, using debt too to help leverage you into something which is working, with you in multiple ways. I just haven't found a smarter, lower risk, and passive-ish level of asset class than what property is. So,
my view. I agree. It's so easy. Like,
it's easy when the market's rising, mate.
Yeah, well,
markets do pull back. It's not the end of the world.
Yeah, but I mean, you just let that happen, right? It's just like sometimes when you're out surfing, you're going to get an absolute flogging. It's like, well, just got to let it happen, and you're going to be able to eventually get back out the back and catch a good wave again. So I spot on agree with like everything you're saying, and this is what I've found. Like some of the wealth, I've been lucky to work with some pretty wealthy people that they just have high income. One thing that's high income, and then they just invest in a bunch of other things that is like less risk. So it's so good to watch those guys invest and speak to those guys, and I've been grateful to adopt some of those principles. And what I'm going to just be pretty controversial here around resi versus commercial. Everybody says commercial is far more passive than resi. I don't think it is. It's not that it's more passive. It's that typically by default, everybody that's investing, and this is because the institutions, the banks, to get finance, you need to have a higher deposit. By default, you need to put more cash and you need to have a 70% LVR or maybe 60, sometimes 75, 80. I'm lucky enough to get to the 80, but with 80% LVR, it's not a passive income. The asset that I'm purchasing for the amount that I'm going for, it's not passive. It's going to be a capital growth play for the first few years, and then it'll start to make a bit more money. Whereas it's the same with resi. I find, you buy something for 80%, it's not going to be 80% LVR, it's not going to be completely passive, but eventually it will start to get more passive. So I think it's a bit of a fallacy that people believe like commercial is far more passive than resi. I don't feel it is. I feel what can make it more passive is you're putting more money into the deal and you're using less finance, which can make it more of a passive income. So I think your passive income really comes from, or in property, it really comes from the more you have, the less debt you have. And that can be both in resi and commercial. Because that's what I found in this deal that I'm looking at for the price point. If I was going to buy something for 500K, of course it'd be a higher passive income. However, I'm going to be missing out on capital growth because I'm spending half the amount or a little bit more than half the amount on a smaller asset. So I will typically be earning with over time, like I'm going for this is where the best investors do really well is they go for the long-term plays. They're not wanting to take cash. They're not wanting to try to get cash as soon as possible. I think this is where people forget or like get burnt with property. Like, I want to buy a property so I can earn passive income as soon as possible. The reality is like, you're not, unless you have a high deposit.
The loan to value ratio.
Chips off the table as soon as possible. Like you just started.
Yeah, well, that goes back to strategy. That people got different strategies. I'm going to tell you right now, if you've got 10 residential properties in your portfolio, you're doing a lot. Like, there's a lot of things going on. You think that's if you've got rates for every single property. You've got small maintenance things here and there that come up. The good investors that I seem to come through, yes, you can make money through property and you get good capital growth out of the residential side. You also get good capital growth out of commercial. But you get to a stage, from what I've come across, is that, there's so many things going on in your life. You want to be traveling, you want to have freedom, you want to do that, but you need to invest money. You don't want to spend too much time, monitoring and looking after your investments. And that's where the commercial space, in my space, it's less time required because there's less things for you to, monitor and maintain. And then when it gets to a stage like in residential, like you're not going to go out and buy a $4 million residential property, because if it like a $4 million residential property, you're going down the development space. That's not passive either. You're working for that, and if you're going to buy a $4 million residential property to buy and hold, your cash flow is going to be shit. It's like that's just the realities of it. But you can go and buy a $4 million commercial and have good cash flow out of that.
True.
So it's like eventually, from what I've come to experience anyway, is like the smart money goes. They understand that residential path and they move into commercial because there's more things that you can, put your money towards. I'd much rather have, 2 or 3 commercial properties that are multi-million-dollar properties that are giving me good income than have a large property for like a $20 or $30 residential property portfolio. Just because of the maintenance, and I'm not there to you should be investing for capital growth and for income to give you the freedom and flexibility in your lifestyle, not for the ego of saying how many properties you got. So go on, if you want to go and buy 9 properties and say how good you are, that's completely fine. I'm getting on a bit of a rant, but you just got to be cautious of people that are like that. It's not hard to go and buy $950,000, $200,000 properties, with decent cash flow. But let's have a chat to those people in 10 years' time. Do they still own that portfolio? How's it performed? Would they do it again? Would they rather use that money to go on into different asset classes? Like it's always case by case, as we know. But I think people lack the time and they get caught up in all this. We're all on our phones. There's marketing. You can do this. You can achieve this. You go down this path. You're not educated. You haven't done like the hard work to go and drop $1 million on something. Go and do the hard work. Go listen to podcasts. Go read books. Put your toe in the water. Like understand how the system works. And generally that starts with residential and then evolving into a commercial play. In my opinion, anyway.
Yeah, it's it's a really good stepping stone, and I think, start, even if you. I mean, if I was to start from the start and I say I had say I had somebody who's got $1 million of cash, should you go and just buy a commercial property straight away? Maybe. Or maybe it's worth like sitting in on a deal, on a resi deal, to go away and do it first, because it is a really good stepping stone to get you into the commercial space. Even with business owners, I did this myself. Is like, I'm just going to buy as many businesses as I can and just be like, look at this dude that's got all these businesses, absolutely killing it. And I bought a bunch of small businesses, and it was just like the dumbest thing ever. And if you realize, like, the really wealthy people, they have less assets but larger assets. So they have less problems and less work and less energy and capacity being taken up in their brain. So it's the same with like property. Why not do that? Now, Sam, I want to ask you, what have you sort of like picked up and learnt through looking at these commercial deals with me that you may not have expected to?
Yeah, good question. What have I picked up? I guess I'll say the assets in different locations, and just, I don't know. I've valued commercial property. I've been around it a fair bit, so I'm there as a bit of a guidance. I guess probably what you're saying is, there's smart money out there. That's a really good point. And you're competing in a different realm. And there's also people that do have a lot of money that, just happy to throw money at things on that front.
Yeah.
I think the biggest thing that I've learned is the importance of good quality coaching advice through this process. And, doing it so many times, you get better at it, and you're able to make faster decisions. I guess I don't know everything, and that's why I'm not buying a commercial property for you. I don't do it every day, so it's just like one of those things that I've come to realize is that you can't be everything to everybody. You got to pick your lane. And I mean, that's probably the biggest thing that I've learned. Other areas probably would be, just around the deepest levels of due diligence checks, of even going through and seeing like foot traffic, and vacancy rate's one thing, but then going deeper into it. And then I actually enjoy the process of analyzing businesses on that front. Like, I'm always that guy that probably is. I do get stuck in analysis paralysis, and you're always looking at, where's, like, what else is there. I do have clients like, I want to see 2 or 3 properties and pick the best one, and it's like, well, they just don't come around like that, and you need to have that confidence to look at a property and trust in the process. I know trust is a hard word to go through when you're spending millions of dollars, but it's definitely, I guess I respect the journey more of what detail goes into buying property, and it makes me better at what I do as well.
Yeah, there's so much in the process. Like, I think we should mention that through acquiring this commercial property, we haven't yet got an offer accepted and then gone to full due diligence and finance yet. I've got pre-approval for finance, and I've also gone and got like a few getting close to an offer accepted. We haven't done full DD yet. So I guess we're going to have to update more on the journey of like what we learned through the due diligence process, because there's going to be a lot of lessons in that as well.
Yeah, definitely. I mean, that's what the whole purpose, right? We go through this process, and we learn about every step of the way, and sharing the journey, I think, is more important. And then sure, we'll have a reflection piece down the track, like once you've acquired the asset, we can break down the deal. But I thought it'd be really good for people to understand the differences and the mindset change that you're going through from a residential investor into a commercial investor. and yeah, I guess like your concerns and in that process too, because like there are probably the biggest lesson that I could probably bestow upon people is kind of similar to residential. It makes it there's a lot of comparable evidence to justify to give you that confidence, whereas commercial because there's so much more into it. It's hard to look at an asset and go, oh well, that would that rental makes sense and that purchase price makes sense, because they're just so different. Like you've got different commercial industrial complexes within the same road that have different types of assets that are they're in there. Some have mezzanine, some don't. Then you go into the, I guess, one of the properties that we were looking at, like it was one of three units in WA. They had a large floor area. The comparables only were mainly focused around lower floor areas.
Yeah,
we were having that sort of concern. There's always going to be concerns, but I feel like it's always worth having a go at. Especially going through a buyer's agent, it's their job to put a high quality asset in front of you. It's for you to be able to look over it and go, well, that is something that it makes sense. A lot of people do get caught in, they're looking at the income and the business. The business may not be there in 3, 5, 7 years. So like focus on the location, focus on the asset. And that's what's given me a lot of confidence down your journey, is every asset you've been presented is on its own as an asset is a great asset. Like the things that you're picking your teeth about are around the income and the tenant, but that's because that's like you're not a cashed up person that has like a couple $1 million just sit in the back end. You're investing to better your position. You're taking on that risk, and I want to obviously de-risk it every step of the way. And that comes from solidarity of income. That's just the way the world works.
Yeah. And that's a really good point as well, is like what makes this less stressful is that I wouldn't suggest buying a commercial property without knowing that you have some surplus cash in case. And I've mentioned this to people in business as well. You should always have a war chest. You should have some like surplus cash in case. If I was spending every single last cent I had, or down to like the last couple of $1,000s, it would be a far more stressful process to try and get the price right, because I'm bidding, $100K, sometimes $120K more than what I was initially wanting to send in as offers. So it's worth having a little bit of surplus cash, knowing that you might need to go a little bit higher, or if something is not as perfect, like you can ride out like a bit of a bump, because there might, you just never know. Even with all the due diligence, sometimes the environment can change, and you're just like, well, I didn't expect that. So that's a really good point.
Well, that's the issue, is right. Like a lot of these companies, especially commercial buyers agents, they've just spun them out, and buyers agents, they just spun out business out of nowhere. Like I get friend requests from random people all the time, and I'm like, where's this come from? But they're charging $50,000 for some fees to buy you a property, and it's like, well, what's the pedigree? How many times they've done this? People just like they're not asking those deeper questions. That I've come to realize, and it's only through being in the industry and understanding how it works that you can see the holes in certain people's things, and that goes down to like the marketing budget people are putting into it. It's all really looks great, and people are telling you like, oh, we can get this return, and like, yes, they have got that, they've achieved that, but like they're only telling you it's like the summary page of a book, or the where it's giving you
it's the Instagram reel of the best things they've ever done, or the best like thing that they've done in their life, or the glory stories, and that's all they're sharing.
Yeah, well, it's like, oh, we purchased this property, it's got great cash flow, in the last 12 months it's gone up X dollars. Fantastic, like you're buying property for a 10-year plus period. Everyone tells you that, but they only focus on short-term growth metrics, so that's contradictory. But like commercial space, right? Like we've bought this property, it's 8%, net yield. It's grown, 10% in the last 12 months. you look at that and go, damn, these guys are really good at what they do. What's the tenant? What's going on there? What's the business? Where is that asset located? What's the supply risk around it? Like, it's not a 2-year buy. My property is just, people, sometimes it feels like they're mixing it with shares where you can just spend your $20 and sell out of it when you want. You're spending 50, 80 grand to sell these things if it all goes pear-shaped. So that's like, you get there's all different spectrums. You've got the people that are, super analytical and just suffer from paralysis analysis. And there's people that are on this side of the fence, the higher end, that are like, yeah, whatever, I trust everybody, it'll be fine. And I'm just looking to get, I want to be told this is a great asset. You're making all this cash flow and it's going to grow by 20%. Like, bullshit. If it does grow by 20%, then fantastic, take the win. But you're not buying it for 20% growth in 1 year. You're buying it to be an asset, a legacy asset, especially commercial, that is going to be in your portfolio for 10, 20 years, because that's what you're going to be relying on to give you that lifestyle of traveling around the world or hanging out with your kids or sit on the beach just doing sweet FA.
Yeah, I guess you got to really work out what sort of, and this is what I got asked before I started with the buyer's agent, and I already knew the question everybody should be asking themselves is what type of investor they want to be. For me and you, Sam, we're just let's just park our cash somewhere that's least risk, that's going to allow it to grow. We want the least amount of problems. Obviously, we would like to optimize for growth, but that is completely secondary. Our primary is let's just make sure we've got the safest asset in the right location with minimum risk. Right, that's the type of investors that we are. But then you do have the people that are I'm going for the moon, and they're prepared. I've had somebody that's went and bought a business with an ungodly amount of finance. And I said to him, it's not what I would do. It's not in my risk tolerance, and I would advise against it. But if your risk tolerance is that and you are prepared to go ahead and do it, then do it. But that's definitely your choice. Went away and did it, and it was fine, right? But on those occasions, it can be very dangerous that, you're just going for the higher risk, because typically the higher the risk, the higher the income, but you've got the high risk. So you could have that high income fast, and then you've got to deal with all these problems later. So different horses for different courses, I guess.
Yeah, well, I'm not the person who's going out there touting that you're going to be retire in 2 years or 10 years or any of that, because I don't think you should be looking at life that way. I think you shouldn't be working towards something that, my perfect life's going to be in 10 years if I do this. Your perfect life is now. Let's get philosophical about this, Krause. You're running if you don't like your job and you're investing and you're leveraging yourself to the hill to hopefully retire in 5 years, you focus on the wrong problem. Find something that you enjoy doing. Shift that perception. That's kind of my opinion. You hit on a good point before too, and I was just trying to recall it. It was around some of the best investors, the best investments too. They're just simple buy and hold. Buy, hold, residential home in a good location. It's simple stuff. It's just the ability to maintain and hold it. Everyone's running around there trying to, go and create drop shipping stores or, be a developer that they haven't developed before. To be a good developer, you got to start somewhere, and you're not starting on a multi-lot development that's going to give you $1 million, because you're going up against people that do this. You're going up some of your lend leases. You've got these major companies that do this. They're scouring the whole entire Australian market for good quality, properties to make money on. In the commercial space too. If you get to those sort of $5-10 million commercial, you're up against super funds. They've got teams that are picking the eye teeth out of the best assets, and they have connections. There's always competition, and what I've seen is that people build their base and they've got a long-term mindset, and just try to get out of your head, get rich quick. Understand why do you want to get rich quick, and then sort of maybe work on those inner thoughts first, and then develop your own like thesis. Because my question to you is always, why are you investing? What are you trying to achieve? Because with the answers to that, you can then build the strategies around it to give you the confidence to get there. And my strategies might not be right for you, and that's completely fine. I'm sure there's someone else out there that's happy to take your money and tell you it's going to work, but I just haven't come across that in the 20 odd years I've been trying to research this market and understand where to get the edge. Like, let's talk about you, Jared. Everyone, not everyone, but people do look at you, and like, you've built something that's been that's given you this lifestyle, and this freedom, and this cash flow. But you tell me all the time, it's taken you 12 years to get here,
Yeah, 12-year overnight success. So I think I started my first online business 12 years ago, and I picked up my first personal development book 21 years ago. So I've only been doing personal development and trying to grow as a person for 21 years. Not very long, only 2 decades, Yeah, it's funny. It's funny that people will go and people will see like the last sort of 5 years, my life on the outside. If you look at it, it's like a lot of people will be like, yeah, okay, it's pretty. I'm grateful for where I'm at, and the things that have happened and transpired from that. But there was like only 7 or 8 years of backlog of like slogging, absolutely slogging to get there. And people want to achieve these things, but they aren't prepared to have the sacrifice, and that's okay as well. But just be realistic with where you're at, because I mean, yeah, there's some sacrifice that needs to be made to get there, especially if you are conditioned in a way that I was from birth, from through society. Like, I just didn't learn the things that, I didn't have parents that were like multi-millionaires teaching me how to invest and teaching me how to, be an entrepreneur or anything like that. And yeah, you've got to uncondition yourself from certain thoughts to get to that position where you can, get in that limelight. And like you said before, Sam, is like, people want to achieve these certain things, like make a lot of money really, really fast, but they've got a lot of debts. Let's say it's bad debt, right? A lot of liability debt. And then they've also got a bunch of expenses, and they've also got all these sorts of habits. By the time, like, if you go away and invest in a large asset, online business or a property, your operating system cannot handle that, right? Because you haven't upgraded who you are as a person to be able to withstand going through going through the stages that you need to go through to operate something smoothly, because you can't operate your life smoothly yet, right? Yet. You can get there. But I've seen people that go away, and I call it a leaky bucket syndrome, is they want to buy a large business and they want to go away and get debt, $1 million of debt to acquire it. But in their own life, they haven't got their finances sorted, because they've got liability debt, but they're also spending money on things they don't even know what they're spending money on. They're just leaking money, and they're also leaking energy and leaking a bunch of things. You need to get that sort of operating system working first, because if you just put more debt into that bucket, the faster it's going to pour out, and the faster you're going to like get into like a worse position. So the natural laws of life won't allow you to get there if you don't upgrade your operating system first.
That's a good point to wrap back into commercial property buying, is that, you've plugged those holes through your journey. Like, if you are thinking about commercial, and you're listening to this, and obviously we've done a really great series, and we've sort of been honing in on that of late, is that there's multiple steps that you need to take prior to even getting into the negotiation phase. So, like, it's working with people, having coaches, having mentors, and taking those steps. It's always just take that first step. Like, I keep talking about people doing strategic plans, and it just got to a stage where it's like, you can put a 30-year plan in place, but you don't know what happens the next 5-10 years. But I can understand people's success levels based on where they are, and understand through just conversations what the next in my eyes, obviously the next best step to take, and you're a classic component of it. Like you've done the work, and you have that ability to be extremely successful in your property investing, and it will take time, but you've learned that through, I guess, the baptism of fire of business as well. So yeah, that's probably the biggest insight that I've learned through your journey as well.
Yeah, thanks, man. And I've learned that through other people as well. Like, see people that come into my programs and courses, and some people achieve things super fast, and there's other people that are just trying to work through some of their own stuff. The people that achieve things super fast have like become the person they need to be able to achieve that level of success. And I think that's what people should shoot for, is become the person that you need to be to deserve. Like, if you feel like you deserve, like actually you've done enough work to feel like you deserve something, then you deserve it. But if you're just entitled and you feel like you deserve it and you haven't made some sacrifice, then let's go back to square one. But yeah, thanks, Sam. It's a good chat. Anything else to bring in before compared to resi and commercial before we wrap up?
Nah, mate. It's let's stay tuned. I'd say this is just probably the first step into understanding the process. Let's jump onto another one probably in a couple of weeks, or hopefully just a couple of weeks. By that stage, no doubt you'll have something under contract, and we can walk through the due diligence process as well as a buyer through the journey. Yeah, that'd be really cool. But in the interim, we've got some interesting guests coming on. So I'd say I'm always dangling a carrot because it's got to keep you listening to my annoying voice. But hopefully someone got a lot of value out of this one, because I definitely can see you learning and growing, and it's we're all growing together, right?
Yeah, and that's the goal. That's why we're doing this. So yeah, guys, thanks for listening. Thanks for tuning in, and we'll speak to you soon.
Bye for now.